The year was 1892. A small group of British businessmen started a small company to manufacture biscuits with an investment of 295 rupees, and they started making these biscuits in a small house in Kolkata. Many years go by, this small company becomes bigger and bigger and ultimately has a public issue on 21st of March 1918. In 1921, this company becomes the first company east of the Suez Canal to use imported gas ovens to manufacture biscuits. In World War II, the government trusts this company to manufacture service biscuits for the armed forces. In 1978, the shareholding of this company, uh, the Indian shareholding of this company goes beyond 60%, and it officially becomes an Indian company. In 1989, the company redefines itself from Britannia Biscuit Company Limited to Britannia Industries Limited. Hello, folks. My name is Neil, and welcome to the Fundamentals and Technicals Analysis series, part one. Today, we are going to take a look at Britannia Marie, Britannia Industries Limited. Let's take a look at Britannia as a company to invest in, and let's see how its fundamentals look. So I'll quickly go to Screener, and I will search for Britannia Industries Limited. Right, I've already given you much of history about Britannia, so I won't go through it again. Let's quickly go to pros and cons that what Screener thinks about Britannia. So in the pros, Screener thinks that stock is providing a good dividend yield of 4.37%. The company has a good return of equity over the last 3 years, which is 36.48%. And the company has been maintaining a healthy dividend payout of 98.22%. In the cons, the stock is trading a little high, 24.4 times its book value. But we'll take a look at whether the stock is expensive or cheap in the part two of this series when we do the trend analysis and the technical analysis. The company has delivered a poor sales growth of 9.36% over the past 5 years. So let's take a look at what impact that has on the company's stock and whether it's investment worthy or not. Peer comparison, there's only one peer listed down here, which is Nestle India. As per market cap wise, Nestle India is bigger than Britannia Industries Limited. Let's take a look at the profit and loss statement of this company. Now, the sales in March 2010 was 3,773 crores. It has consistently grown over a period of time. 7, 8, 9, 9. Yes, I don't see any downturn, so to speak, since 2010, except there has been, I can see that the growth wasn't that big between 19 and 20. In 19, the sales was 11,055 crores, and in 2020 it was 11,600 crores, which was a marginal up. But then I'm not going to blame them. We saw COVID and we saw many other things, so so that's okay. I'll take it with a pinch of salt, because in March 2021 the results are out now, and the sales growth has been good. So I see that they've picked it up again in 2020. The net profit has been consistently growing since March 2010, from 103 crores to now 1,864 crores. Let's look at the balance sheet, and the two important factors that I look at in the balance sheet is the liabilities and the assets. The liabilities were 574 crores in 2010, and the assets were 1513 crores, total assets, 1,513 crores, which is roughly about 2.5 times of the liabilities. The liabilities have grown over a period of time, and I consider that to be healthy growth, considering the top line has also grown consistently over a period of time to 2,374 crores in March 2021. The assets have also shown a much faster growth to 8,009 crores, which means now it's about 4 times or more than 4 times of the liabilities. Well, about 4 times. So it was about 2.5 times here, it's about 4 times here. The difference between the liabilities and assets has increased, and that's a very, very good sign. The cash flows are up and down a little bit. It was minus 22, then 13, then minus 30, then 68, and minus 47, and so on and so forth. But it's now at a healthy 69 net cash flow, so which is excellent. Cash flows are looking decent. The ratios are excellent actually. So if you look at the ROCE, which is return of capital, it was at 16% and now we are at 45%. Anything above 20%, I consider that to be a healthy sign, and we are doing much better than that. We saw a little bit of a sort of downturn in March 2020, but we've picked it up from there in March 2021. The debtor days, if you look at it, has been consistently maintained at 17. It did go up a little bit to 11 and 13 days, but now we are back in control at 7 again. Now, debtor days can be, the more the debtor days, the worse it is for the company. It basically means that the company takes more number of days to return the money that they have borrowed. In this case, 7 days. So it takes 7 days for the company to return the money that they've borrowed, which is an excellent sign. Anything above 30 days is slightly not so good. The debtor days can be much more as well when it comes to other companies. Let's look at the shareholding pattern. The promoters have maintained a consistent 50% over the years since 2018, and now we are at 2021. Foreign institutional investors have also maintained a healthy 17 to 18% roughly. The domestic institutional investors have also retained their stake in the company. What all this means is that these institutional investors and the promoters think that the company does have a bright future, and that's the reason they've not really sold off their share of the stocks. The retail investors were at 19%. They have, been at 19, about 19.76%, which is very close to 20%, and now we are at about 20.26%. It did go up a little bit in these years because the foreign institutional, domestic institutional investors did sell out some amount of stocks in the company in September 2020 and December 2020, but they've regained their stake now, and that's why the retail investors have also reduced their stake in the company. So all in all, the company looks a very healthy and good company. While it can provide an excellent growth to your investment in the company, I think the risk is much lower, and that's what's more important for me. How risky is your investment? Because we're talking about investing in stocks directly, and I prefer that over mutual funds. So first thing that I would look at is how risky is the stock that I'm investing in, and this looks like a very stable, strong, company that provides a very, very healthy growth. Let's quickly take a look at the corporate actions that will define, whether it can give us compounding or not. Because there are three ways that your money compounds besides the price going up: the bonus shares, the split shares, and the rights issues. And if you look, let's take a look at how the company has done over the years. Now, since 2005, the company has been consistently giving out good dividends year on year to their investors. It gave its first bonus in March 2010. It was a 1:1 bonus, and then in the same year, it also gave a split of 1:1. After that, the next bonus that the company gave was in 2008. Oh, it wasn't a bonus; it was a split. In 2018, it was again a 1:1 split, and then it hasn't given any split. So 8 years, and there's no bonus or splits given. Now, it did give a split in 2018, so I don't see us getting a split in the next couple of years at least. It's not given out a bonus since 2010, so we may or may not, I'm not sure, get bonus shares in the next 1 or 2 years. All in all, I think that it's a healthy company, and I think that it would be a good idea to invest in this company and stay invested. You'll definitely get the dividends year on year, that is for sure. The company has maintained a healthy, the promoters have maintained a healthy stake in the company, which means they think that the company has a bright future. The assets and liabilities difference has increased, which essentially says that the management is doing an excellent job with the resources. The ratios look good, the liquidity look good. I think that this is a good company to invest in. We will take a more detailed look at the technicals and the trend analysis to identify what would be a good price to enter this stock, what would be a good price to exit this stock for a long-term investor, for a swing trader, and for an intraday trader in part 2 of this episode 5 of the fundamental analysis and technical series. I hope to see you then. Um, I hope you like the content that I have produced, and I'm always looking for feedback. Do let me know if you have any ideas that you would like me to cover. Other than that, I wish uh, the best of luck to all of us, and I hope you make a ton of money off the stock markets. Have fun.